Hello everybody, Steve Griffiths here, developer of the MTPredictor software program. In this MTPredictor video, I'd like to have another look at our Wave 3 or W3 trade setup in MTPredictor. This time looking at a Forex chart. But as usual, we have to start with our risk disclaimer and just remind you that all examples in these videos should be considered as hypothetical. No trades are actually taken, they're just shown for illustration and training purposes only. Remind you there's a risk of loss in trading and investing. Put another way, all professional traders know and understand, but more important, accept that losses can and will and do unfold. That's an important point. No matter what approach you use, there will always be losing trades. So I want to have a look at the Swiss franc Japanese yen. And the trade setup I'd like to look at is on the hourly chart, which is this W3, this TS1 W3 trade setup here. So what is this and how do we actually look to identify this? Well, this is a potential Wave 2 after the market starts to make a meaningful reversal of a higher time frame support and resistance. Let me just show you what I mean. If I right mouse click here and do Elliott wave minor, you can see this decline down here subdivides into an ABC, and if I come to the top here and do Elliott wave major, you can see here we have a wave 1, a wave 2 which subdivides into an ABC, and then we have a strong wave 3. So what we're trying to do with this W3 trade setup is catch the end of the wave 2 to then trade the wave 3, because as we know, wave 3s are normally the strongest and longest wave in a completed 5-wave sequence, therefore represents the largest potential profit in relation to the smallest initial risk. Now for you guys who've been following MTPredictor for a while will know that we teach that markets move in cycles. So about half the time, or just slightly more, markets tend to be random and you can't make any discernible pattern or any discernible analysis at all because the markets are basically random. So how do we then decide when the markets are not in a random phase? For this we go to a higher time frame chart. So from an hourly chart you'd go out to a time frame between 3 and 5 time frames higher. So this would go out to the next time frame up, which will be 4 hourly. If you're on a daily chart, you go out to weekly. If you say on a 3-minute chart, you go out to a 15-minute chart. And we go back to look at to see whether the market is coming off higher time frame support in this case, or if you're looking for a short trade, it'd be resistance. So this area here is where our W3 or TS1 W3 trade setup was unfolding on the hourly chart. So if I go back in time to here somewhere, what I want to do is place the DP as a potential support area on the chart. Now I'm going to use the last swing into this high. This is what we teach in our training webinars. So you right mouse click here, do decision point. Can you see how that's on the chart in advance? It's there before the market even gets there. So if I turn training mode off, can you see how the market came down? It came into that support zone before it started to rally. So now if I go down to the shorter time frame chart, let's see how that looked. So there you can see the market has now just tagged that level just about before it starts to rally up. So in other words, the market started to make a meaningful reversal at the higher time frame support in this case. So this is where we start our Elliott wave sequence. This is why I developed my unique isolation approach to Elliott wave, in that we look at Elliott wave patterns in isolation because markets are random half the time. So what we assume is the market now is becoming clear. So this would be the initial move up, which would be wave 1. This will be the initial correction, which would be wave 2. If I right mouse click over this blue buy bar, do the analysis. Here the wave 2 subdivides into an ABC, and this sets up our W3 or wave 3 trade setup. The initial target would be the typical wave 3 WPT, and you can see the market rallied up to that level quite nicely, where potential profit was available of approximately or just over 5 times initial risk. Here we use position sizing to vary the number of lots. In this case we'll be trading Forex or looking at Forex lots or contracts or shares to keep our initial risk small, in this case less than 2% on a sample $20,000 account. So as you can see here, it was a nice profit of approximately 5 times the initial risk. Or what this means is when you make losing trades, and you will, these will be considered a -1R or 1R loss, and here the profit was 5 times that potential loss or the initial risk. If we go out to the higher time frame chart, more experienced users would have probably looked to the next higher time frame resistance area. So this is the last swing into that low. So you right mouse click there. That would have been a potential resistance area on the chart. The next pivot to use going back would be the last major high, which was there, right mouse click, decision point, and again that would have been on the chart in advance. And as you can see, this is where the Swiss franc Japanese yen has actually made its high. So if we come back down to the 1 hourly chart, rather than looking to come out at this first target here, you could look to perhaps run your trade a bit further and look to perhaps go up into the next higher time frame resistance. Maybe here, if you had done, the profit could have been increased to just about 6.5 times the initial risk, or maybe up into the next resistance area up there, and the profit will be almost 10R, 9.8, 9.5R, around there, almost 9.9, you see, almost 10R profit. But either way, the point being is that this particular setup, which is our W3 or wave 3 trade setup, is designed to catch the end of a wave 2 to then get you in a wave 3 move, which is normally the strongest and longest in a completed 5-wave sequence. So do you remember what we do? We assume that markets are random, or we understand that the markets are random half the time or slightly more. So we look for when the market becomes less random and the picture becomes clear. To do that, we go out to the higher time frame chart, in this case the 4 hour. We place our DP support and resistance zones on the chart. These are on the chart in advance. We then wait to see whether the market is making a meaningful reversal off these levels, and then we look to the shorter time frame chart to then see whether the trade setup potentially is occurring. Our MTP trend was also blue in this case, indicating the larger trend was up. So that shows a good example on the Swiss franc Japanese yen.